IBIT ETF. Is Bitcoin's Nemesis a friend or foe for investors? Calling all crypto enthusiasts and risk-tolerant investors. Are you fascinated by Bitcoin, but wary of its wild price swings? Enter the IBIT ETF, an intriguing product designed to profit from Bitcoin price declines. But before you jump in, buckle up. This video dives deep into the IBIT ETF, exploring its unique strategy, potential benefits, and critical risks you need to understand. From its inverse performance to the complex financial instruments it uses, we'll unpack everything you need to know about IBIT. Is it a revolutionary tool for navigating the volatile Bitcoin market, or a ticking time bomb waiting to explode? Let's find out. Question 1. What is the specific investment objective or strategy of the IBIT ETF? The IBIT ETF has a unique investment objective and strategy compared to most ETFs. Here's a breakdown. Objective. Inverse performance to the Amplify ETF. IBIT aims to deliver daily results that are the opposite of the Amplify ETF's performance. Essentially, if the Amplify ETF goes up 5%, IBIT aims to go down 5%. This means you can gain from Bitcoin price declines by holding IBIT. Strategy. Not direct Bitcoin exposure. IBIT doesn't directly invest in Bitcoin. Instead, it uses swap agreements, contracts with other parties to exchange the performance of the Amplify ETF for another asset. Short sales, borrowing and selling Amplify ETF shares, hoping to repurchase them later at a lower price and profit from the difference. Important notes here. 1. Compounding impact. Due to compounding, IBIT's performance over longer periods may differ significantly from the inverse, minus 100%, of the Amplify ETF's return. 2. High volatility. Both Bitcoin and IBIT are highly volatile, meaning their prices can fluctuate significantly. This increases risk for investors. 3. Knowledgeable investor requirement. This ETF is complex and designed only for investors who understand the risks of inverse performance, shorting, and high volatility. Question 2. What types of assets or securities does the IBIT ETF primarily invest in? While the IBIT ETF doesn't directly invest in any specific assets or securities, it achieves its objective through two main strategies. 1. Swap agreements. These are contracts with other parties where IBIT agrees to exchange the performance of the Amplify ETF for the performance of another asset. This other asset is not publicly disclosed, but it's likely a cash equivalent, or a basket of securities that aims to track the daily performance of the cash equivalent. 2. Short selling. IBIT borrows shares of the Amplify ETF and sells them in the market, hoping to repurchase them later at a lower price and pocket the difference. This creates an inverse relationship to the Amplify ETF's performance. Therefore, IBIT doesn't hold any underlying assets itself, but rather uses financial contracts to indirectly gain exposure to the Amplify ETF's performance in an inverse way. It's important to remember that these financial contracts can introduce additional risks compared to directly holding assets, so understanding the specifics of the swaps and shorting strategy is crucial before investing. Question 3. What are the key factors that influence the performance of the IBIT ETF? Since the IBIT ETF doesn't directly invest in assets, but instead uses financial contracts to achieve its inverse performance objective, several key factors influence its performance. 1. Performance of the Amplify ETF. This is the most critical factor, as IBIT aims to deliver the opposite daily return of the Amplify ETF. If the Amplify ETF goes up, IBIT goes down, and vice versa. So, understanding the factors affecting the Amplify ETF's performance, e.g., Bitcoin price movements, market sentiment towards Bitcoin, regulations, is crucial for understanding IBIT's potential returns. 2. Costs of swap agreements. As mentioned earlier, IBIT uses swap agreements to track the Amplify ETF's performance inversely. These swaps incur costs, which eat into IBIT's returns. The specific costs associated with these swaps depend on various factors like interest rates, counterparty risk, and market conditions. Higher swap costs reduce IBIT's returns compared to the perfect inverse of the Amplify ETF. 3. Shorting costs and risks. IBIT also employs short selling of the Amplify ETF shares, which involves borrowing shares, selling them, and repurchasing them later. This strategy incurs costs like borrowing fees and potential risks like short squeezes, where the borrowed shares become difficult or expensive to repurchase, leading to losses. Effective management of these costs and risks is crucial for IBIT's performance. 4. Tracking error. While IBIT aims for a daily return opposite to the Amplify ETF, due to various factors like swap costs and timing differences, its actual returns may deviate from the perfect inverse. This deviation is known as tracking error, and it's essential to consider when evaluating IBIT's performance. 5. Bitcoin market volatility. Both Bitcoin and IBIT are inherently volatile due to the fluctuating nature of the cryptocurrency market. This volatility can lead to significant swings in IBIT's price, amplifying both potential gains and losses. Investors should be comfortable with this volatility before considering IBIT. Question 4. What are the key performance metrics the issuer uses to track the ETF's success? As the IBIT ETF is designed to achieve the opposite daily return of the Amplify ETF, its performance success isn't tracked using typical metrics like net asset value, NAV, or total return. Instead, the issuer likely focuses on metrics that gauge how closely IBIT achieves its inverse return objective and its overall risk-adjusted performance. Here are some key metrics they might use. 1. Tracking error. This measures the difference between IBIT's daily return and the negative of the Amplify ETF's return. A lower tracking error indicates the ETF is performing closer to its intended inverse objective. 2. Sharpe ratio. This assesses the ETF's return compared to its volatility. A higher Sharpe ratio indicates better risk-adjusted returns, meaning IBIT delivers higher returns relative to its risk compared to other investments. 3. Maximum drawdown. This measures the largest peak-to-trough decline in IBIT's price over a specific period. It reflects the maximum potential loss an investor might experience. 4. Expense ratio. This represents the annual management fee charged by the ETF issuer, expressed as a percentage of assets. A lower expense ratio translates to less erosion of IBIT's returns. 5. Daily return distribution. This analyzes the historical distribution of IBIT's daily returns, providing insights into its volatility and potential for large gains or losses. It's important to note that the specific metrics the issuer prioritizes might not be publicly disclosed. However, understanding these key performance indicators can help you assess how effectively IBIT is achieving its objective and managing its risks. Question 5. What are the eligibility criteria for assets to be included in the IBIT ETF? The IBIT ETF, unlike traditional ETFs that hold underlying assets, doesn't directly invest in any securities or assets. Instead, it achieves its objective through 1. Swap agreements. These contracts with other parties allow IBIT to track the performance of the Amplify ETF inversely. The specific asset underlying the swap isn't publicly disclosed, but it's likely a cash equivalent, or a basket of securities mimicking cash performance. 2. Short selling. IBIT borrows shares of the Amplify ETF, sells them, and aims to repurchase them later at a lower price, profiting from the difference. Therefore, IBIT doesn't have eligibility criteria for including assets, as it doesn't hold any directly. Its performance solely relies on the Amplify ETF's movement and the mechanics of the used financial instruments, swaps and short selling. Here's a breakdown of why asset eligibility doesn't apply to IBIT. 1. No asset holdings. Unlike traditional ETFs with specific investment mandates, IBIT doesn't hold any underlying assets like stocks, bonds, or commodities. 2. Performance-based tracking. IBIT tracks the Amplify ETF's performance inversely, not the individual assets within the Amplify ETF. 3. Financial instruments. The swaps and short selling used by IBIT are financial contracts, not direct ownership of assets. Question 6. What is the geographic focus of the investments held within the IBIT ETF? It's important to remember that the IBIT ETF doesn't directly hold any investments itself. Instead, it achieves its objective through two main strategies. 1. Swap agreements. These contracts track the performance of the Amplify Bitcoin ETF, BITO, inversely. The underlying assets of the BITO ETF are Bitcoin futures contracts, which are traded globally on various cryptocurrency exchanges. So, geographically, the exposure is spread across the locations of these exchanges, which can include the United States, Europe, and Asia. 2. Short selling. IBIT borrows and sells shares of the BITO ETF, hoping to repurchase them later at a lower price. Since BITO itself is an ETF and not a single company, it doesn't have a specific geographic focus. However, the liquidity and availability of BITO shares can be influenced by the regions where investors are actively trading it. Therefore, while IBIT doesn't have a direct geographic focus due to its reliance on financial contracts, its performance can be indirectly impacted by the global distribution of Bitcoin futures trading and the location of BITO ETF investors. Here are some additional points to consider. 1. The specific exchanges where Bitcoin futures contracts are traded can change over time. 2. Regulatory environments in different regions can also affect the Bitcoin market, and, consequently, IBIT's performance. 3. It's crucial to remember that IBIT's main objective is to achieve the opposite daily return of the BITO ETF, regardless of the geographic distribution of its underlying assets. Question 7. What are the sector allocations within the IBIT ETF's portfolio? The IBIT ETF, unlike traditional ETFs that hold underlying assets categorized by sector, doesn't have a portfolio or any sector allocations. Here's why. No portfolio of assets. As mentioned previously, IBIT doesn't directly invest in any stocks, bonds, or other traditional assets. It achieves its objective through financial contracts, swaps and short selling, linked to the Amplify Bitcoin ETF, BITO. Focus on performance, not sectors. IBIT aims to deliver the opposite daily return of the BITO ETF. The BITO ETF itself holds Bitcoin futures contracts, which don't have specific sectors in the traditional sense. Financial instruments used. Swaps and short selling track the BITO ETF's performance, not the sectors of its underlying assets. These contracts don't have sector allocations. It's important to understand that IBIT is a unique ETF with an inverse performance objective rather than a standard investment strategy based on sector allocations. Its performance solely depends on the movement of the BITO ETF and the mechanics of the used financial instruments. Question 8. What are the primary risks associated with investing in the IBIT ETF? The IBIT ETF, while offering the potential for gains from Bitcoin price declines, comes with several key risks that investors should be aware of before considering it. 1. Inverse performance risk. IBIT aims for the opposite daily return of the Amplify Bitcoin ETF of BITO. This means that if Bitcoin goes up, IBIT goes down, and vice versa. While this can benefit from Bitcoin price declines, it amplifies losses if Bitcoin rises. Additionally, due to compounding effects, IBIT's returns may differ significantly from the inverse of BITO's performance over longer periods. 2. High volatility. Both Bitcoin and IBIT are inherently volatile assets, meaning their prices can fluctuate significantly. This volatility can lead to rapid and substantial losses even for seemingly short-term investments. 3. Complex strategy. IBIT employs financial instruments like swaps and short selling, which are more complex than traditional stock or bond investments. Understanding these instruments and their associated risks is crucial before investing. 4. Tracking error. While IBIT aims for the inverse of BITO's return, various factors, like swap costs and timing differences, can cause its actual performance to deviate. This tracking error can erode potential gains or amplify losses. 5. Counterparty risk. Swaps used by IBIT involve agreements with other parties. If these counterparties default, IBIT's performance could be negatively impacted. 6. Short squeeze risk. Short selling involves borrowing shares, selling them, and repurchasing them later. If the borrowed shares become difficult or expensive to repurchase due to market conditions, short squeeze, IBIT can incur significant losses. 7. Regulatory risk. The cryptocurrency market is evolving, and regulations are subject to change. Regulatory changes could negatively impact Bitcoin's price, and consequently, IBIT's performance. 8. Fees and expenses. The IBIT ETF has management fees and other expenses, which eat into its returns. These fees can be higher than traditional ETFs, due to the complexity of its strategy. 9. Limited availability and liquidity. IBIT is a relatively new and smaller ETF, meaning its trading volume and liquidity might be lower than other ETFs. This can make it more challenging to buy or sell shares quickly and at desired prices. 10. Lack of diversification. Unlike traditional ETFs that hold a basket of assets, IBIT solely focuses on tracking BITO's inverse performance. This lack of diversification exposes investors to concentrated risk within the Bitcoin market. 11. Suitability for experienced investors. Due to its complexity, high volatility, and unique risks, IBIT is generally considered suitable only for experienced investors who understand and are comfortable with these risks. So, is the IBIT ETF a friend or foe for investors? The answer depends on your risk tolerance and investment goals. While it offers the potential for gains when Bitcoin dips, its complexity, high volatility, and unique risks demand careful consideration. Remember, investing in IBIT is not for the faint of heart. Before making any decisions, do your research, understand the risks involved, and consult with a financial advisor. After all, informed investing is the key to navigating the exciting, yet often treacherous, world of cryptocurrency. Thanks for watching. And remember, when it comes to investing, knowledge is power, and power protects your portfolio.